Hey, Money Guy family, you probably have questions about mortgages. This is an important decision. We've got a best of series that's going to hook you up.
And likely is connected to the largest purchase that you will ever make, so you want to make sure that you do it right.
It's Brian Preston, the Money Guy.
I get it. When you go read books, like Chris Hogan has a great book, Everyday Millionaires, he shows that the average millionaire pays their house off in 10 years.
Yep.
You see that, that's a headline, and you're like, wow. So a 15-year mortgage is going to be probably what I need to do. I need to get out of debt as fast as possible. If you go read the detail or go listen to interviews of what Chris Hogan has talked about, he has shared that was not this person's first house. Mm-hmm. This was typically the millionaire realizes in their 40s or 50s. So this is probably their second or even third house. And yes, that is probably, I resemble a lot of that. And it is true. I will have my current house paid off within 10 years.
But this is not your first house.
Exactly. Because realize there's a lot of 25-year-olds. There's a lot of 30-year-olds. There's a lot of 35-year-olds that are watching this show. And you're being financially shamed in the fact that because you have so many talking heads, they'll say, this is the way you should do mortgages. You should do 20% down and finance them over 15 years. And you're seeing that and you're like, I live, and the cost of living is going up in my community. The cost of housing is going up. I feel like I'm on a treadmill where I can never catch up. And you know who can put down 20% on a 15-year mortgage? Rich people.
That's right.
And we're trying to get you to rich people status, but a lot of us don't start at rich people status. We have to kind of build the blocks to get there. So I want to kind of give one more reason why I think you can give yourself a little more breathing room without disrespecting how much you should spend on housing to the rest of your financial life. So realize, Money Guy rule that we talk about, Bo. Housing should be 25% of your gross income.
That's your top line. You can't go over that. If you go over that, perhaps you're buying more house than you can afford.
So how you spend that 25%, we're going to give you a lot of flexibility and freedom. And we've confessed this before, and I know we take a little flack, but I like to be very transparent with you guys. My first house, I put down 5%. Bo's first house?
3.5%.
So and we went around and interviewed a lot of our staff, and I think only 2 of our employees put down 20% on their first house. I think it was Carter.
Yep.
It might only be one. It might have been Eric. But there was only 2 employees, because even Carol surprised me, because she is Mrs. CPA, super conservative, great with her money. She even confessed she was just like me. She didn't put down a full 20%. And we get it. When you're young and you're trying to do all the things you're trying to do financially with the kids, the family, the job, saving for retirement, life is kicking you in the rear end. Your wallet is just not gushing with overflow. So you're trying to make sure every dollar has a purpose and you're doing it. So that's why I want to give you that breathing room to be real with you, so I don't just look like a successful guy that's now shaming you because you're not putting down 20% and doing a 15-year mortgage. Because also think about every house decision you make, you got to raise the kids there. Mm-hmm. So if you're raising the kids, let's talk about if you only have a certain pot of money, it's at 25% of income. Let's look at some of the realities of how that actually plays out too.
Yeah, so again, in true Money Guy fashion, why not let's do another case study. So let's assume that you have a family that in the household they make $100,000 a year. We know that housing costs can only go up to 25% of your gross income, so that's $2,083 a month is what your housing costs can be. But we also know that when you buy a house, there are other things that come along with it.
It's not just principal and interest.
That's exactly right. They're going to spend about $600 a month on utilities, taxes, and insurance. So what that really means is when they look at their mortgage payment, that leaves about $1,483 a month that they can spend. So the question then becomes, if $1,483 a month is what I can spend, how much house can I afford? How much house should I buy with that?
So let's look at this, because I thought this was a very important thing. In America right now, we know that the average size of a house in America is between 2,600 to 2,800 square feet.
Yep.
And we also know now people in New York, people in California are going to laugh at this next number I tell you, because I just had to choose a number because it depends upon where you build a house or where you buy a house. Cost per square foot, I just landed on $130 a square foot. Now, even here in Nashville, we're laughing about that number because that seems super low. But in other parts of the country like Georgia, where we came from, you could buy a house for $100 a square foot. So I just landed on 130. So that way, I know I'm going to get laughed at by the coast. I'm going to get laughed at places like in Nashville, but it at least gives us a conversation point because it's low on purpose to be conservative. So if we know housing is $130 a square foot, how much house can you afford to buy if you know what that $1,400 a month housing payment can buy? So
here's what we figured out. If you're looking at a 15-year mortgage, you can afford a mortgage of $207,000, and at $130 a square foot, again, this is assuming after a 10% down payment, you can buy a house that has about 1,769 square feet. And I think you even had the number, Brian. This isn't a house that's equivalent to $230,000.
Exactly right.
So, okay, that is an idea. So for a young family starting out, 15-year mortgage, $230,000 house, 1,769 square feet. Without changing your cash flow, without spending more money, without having more cash, without going outside of your 25% realm, we said, well, what if instead of doing a 15-year mortgage, we decided to do a 30-year mortgage? How much house could we afford on our $1,483 a month mortgage payment?
Wow, look at that. That's a dramatic difference. Now you can afford a $367,000 house, probably around 2,800 square feet. So that, you know, the kids, you get enough house that it's not so big that it's going to be a mess to maintain, but it's big enough that you don't feel like every time you walk you're stepping on a Lego and tripping and hurting yourself. I mean, I think that this is a big part. And here's something that I like to always close with an exclamation point on this issue. A 30-year mortgage can very easily, especially when you're at interest rates as low as we currently are, a 30-year mortgage can actually be a 5-year mortgage. A 30-year mortgage can be a 10-year mortgage. It can be a 15-year mortgage. It can be a 20-year mortgage. They don't have prepayment penalties. So all you have to do, you have maximum flexibility that all you have to do is pull out your nerdy financial calculator, change your maturity date that you want to have the loan paid off, and start increasing your monthly payment. Guess what? Your 30-year mortgage magically, just like a transformer, has converted itself into a 10 or 15-year mortgage. Now reverse that. You go ahead and you do the 15-year mortgage. And you look at it, and maybe you decide, because I'll tell you my personal story. 15-year mortgage. I learned, remember, wisdom is created through experience. Did a 15-year mortgage on my second home. So proud of that. It was at 4 3/4, which was a steal on a 15-year mortgage at the time. But then we decided we were going to be moving. All of a sudden, I'm kind of regretting that 15-year mortgage because I knew that there was a period, especially when moving to Tennessee, I might have 2 houses for a little period of time. And believe me, having the squeeze of a 15-year mortgage then plus a new 30-year mortgage, it would have been a lot better if this was a 30-year mortgage and this was a 30-year mortgage so that I could have the flexibility. The same thing happens to you guys. When you do a 15-year mortgage, can it become a 20-year mortgage, Bo?
Nope.
Can it become a 25-year mortgage?
Not without refinancing it.
It sure can't become a 30-year mortgage.
That's right.
And I found that out. So if you want maximum flexibility, I will tell you there's nothing wrong with still having the intention of paying your mortgage off in 15 years, but doing a 30-year mortgage because there's no prepayment penalty. Go ahead, knock it out of the park, get yourself the flexibility. It also allows you, because here's the other great thing I like about Money Guy family members. We all start somewhere.
Yeah.
I mean, my first salary right out of college was $28,000 a year. Can't afford a lot of house at $28,000 a year. But the good news is just like a lot of you guys, you're on the, I mean, we start at the bottom, but now we're moving up to here. So you know your income is going like this. Do the mortgage financing so that you have maximum flexibility so that when your pay raises come, you will have the flexibility. You can always accelerate those payments. But let's go over some Money Guy teachable tips.
Yeah, I was going to say, so what is our recommendation in terms of how you approach mortgages and paying off mortgages? And Brian, I don't know. I don't remember when this happened, but one day I think you just woke up and you came up with a number, but it's just such a good number. You finally said, look, there's a dividing line. If you're on this side of the line, do one thing. If you're on this side of the line, do something different.
And it's all driven by the fact of compounding growth for your retirement assets and you know what you can expect, but also try not to take too much risk that you don't run the whole enterprise into the ditch. So there's a balance there. And I think anybody under 45, you're really kind of It doesn't make sense, especially in an interest rate environment like right now, where you can get a 3.5 to a 4.25% interest rate. There's no reason to go prepay all that stuff while you could have growing assets that you'll need for retirement. But then when you get over 45, I think that it's okay. You want to simplify. Your life is changing. The compounding growth effect is not as powerful as it was when you're 25 years old. Why not get out of debt completely? And look, I had this discussion just a few days ago. Somebody said, why would you ever pay your mortgage off? And I was like, it's not a numbers point. At that point, there is a point where you go cross over from a psychological standpoint, from a peace of mind standpoint. That's why you want to own your life at retirement, is because the word encumbrance, which debt is, does not go at all with financial independence. How are you independent when you have something that is encumbering and creating an obligation for you?
And I think sometimes, Brian, I get caught in this trap of stuff that's common sense to me, I recognize is not always common sense to the people that I'm around. I've had this conversation 4 times in the last month, talking with young folks who've had a desire to prepay their mortgage. And I say, I think it's great if you want to get out of debt and do that. But by putting the money on the mortgage and satisfying the mortgage, you may not be doing yourself any favors, because you still have the ability. If you say, you know what, I want to pay off my mortgage in 10 years, you could still save that money outside of paying off the mortgage, build up an after-tax account, and then if you so chose 10 years from now, you could just write a check and pay off the mortgage. Yep. What it does is it leaves maximum flexibility in your corner, because once that dollar goes into the mortgage, we just saw what happened to you in 2000. It's hard to get that dollar back out, especially if there's some sort of downturn. I want to
go a little deeper, because if I had a house, I showed an example earlier. If you're watching the highlight instead of the full show, if you go watch the full show, I showed that my house at the end of 2006 back in Georgia was worth $510,000, but just 4 short years later, less than 4 years, it was like 3.5 years, it was worth $270,000. Yep. So all that equity kind of evaporated. So think about this in terms of, if you were prepaying your mortgage, if you're a 25 or 30-year-old or 35-year-old who's just dumping money to get debt-free, you don't really get the benefit of flexibility of saving that monthly payment until it's completely debt-free.
That's right.
If it's going to take you 10 years to hyper-aggressively pay off that mortgage, but you lose your job in year 6, it's not easy to go pull all that 6 years of aggressive payment back out. You'd probably be better served from a flexibility if you had that money in something liquid, like an investment account. And if it's a diversified investment account, you probably wouldn't have to go yank all of it from equities that are down. You might be able to go pull some of it from conservative assets to bridge getting over the life stuff that just happens.
Yep. People need to understand, we love you paying down your mortgage. I don't want you to mishear me. I do want you to be completely debt-free as you approach retirement. But you have to understand the power of compounding interest. There's about 20 years that you need to maximize all the opportunities, plus all the craziness that happens in the messy middle. Today we want to do a case study to kind of proved our point a little bit further.
And we're going to walk through some common misnomers, because we keep hearing from you guys, which we love. We love hearing your feedback. We love hearing you guys leaning in, saying, no, guys, you forgot about this. Oh, well, what about this? Oh, well, what about this? Well, we didn't actually forget about those things. We're going to address them front and center today as we kind of walk you through what we think are the pitfalls of paying off your home early.
So, of course, we couldn't start this show without having an FTE Daniel case study. And I thought it was interesting. We changed the name from Dave to Paul because a lot of people thought, and that was the last time we did this. We didn't do Dave to pick on
totally
Dave Ramsey.
Freudian.
That was not us picking on Dave at all. So we changed the name to Paul and Melissa. Now, we chose 33 years of age. Here's why we did this. This is what I said, Daniel, go find me what the average age for first-time home purchasers are. And it was 33 years of age, so that's the age we made, both Paul and Melissa.
Now, I found that so interesting because you weren't 33 when you bought your first house, were you?
25.
25, and I was 21 when I bought my first house.
Maybe 24.
So when I heard 33, that just seemed, but it makes sense. You know, you hear a lot of
houses are a nickel here in Georgia. Well, not in Tennessee, but in
Georgia.
Nashville. In Georgia, houses were a nickel. So it was a lot easier to buy a house when you're 24 years old when they're cheap.
I just thought that was really interesting. But we said, okay, so we want to stack the deck here and actually look at these two savers. All right. So we're going to look at Paul and we're going to look at Melissa, and we're going to assume that they both buy a home. They're going to purchase the home for $300,000. They're going to be responsible, put 20% down, so they both are going to take out a loan of $240,000. Yeah. All right, so we have equivalent purchases, equivalent consumption here. So if we look at Paul, he says, you know what, I want to be debt-free as early as possible. And I've listened to all kinds of shows, and I follow all the financial stuff, and I know that a 15-year mortgage is the best way to do that. So I'm going to go out and get a 15-year mortgage. But Melissa says, you know what, I listened to the Money Guy show, and I've heard about this thing with this army of dollar bills, and so I am just going to do a normal 30-year mortgage. Well, because Paul opted for the 15-year, he actually gets a better rate. He has a 2.5% interest rate on his mortgage, where Melissa has to take a little premium on the 30-year. She's actually going to pay 3.25% interest. So if you amortize those two loans, Paul's minimum monthly payment is $1,600 a month. If we just look at principal and interest. His minimum monthly payment is $1,600.
For 15 years.
For 15 years. Well, if we look at Melissa, her minimum payment, because she gets to stretch it over 30 years, is actually going to be $1,044. So it's roughly $550 less than Paul's. But again, we wanted to set this up to be an equivalent illustration. So this is what we assumed. Paul's going to pay off his mortgage over that first 15 years. And then starting in year 16, he's going to invest all $1,600, right? Because that's the argument that we have people say, you know what, if I pay off my mortgage early, I'm going to have more money to invest sooner.
That's exactly right.
If you're someone making that argument in your head right now, pay attention to the illustration.
And also realize, because everybody always says, are you guys including the interest? Yes, we are totally including the interest. As you'll notice, we even give Paul the benefit of, since he's taking a shorter loan, we give him a lower interest rate at 2.5%. Melissa's 3.25%. That creates a headwind for Melissa initially, because realize they both start off with $240,000. Melissa's paying more interest than Paul is. So we could have skewed this if we were just trying to prove our point for the sake of it. We could have manipulated the data, but we tried to make this as honest and true as possible so you guys could really see how this thing flows through.
So again, remember, we're trying to set up equivalent examples. So we assume that in addition to Melissa's $1,044 minimum mortgage payment, she's going to invest an extra $556 per month. So what that means is both Paul and Melissa have $1,600 flowing out every month. It's the exact same number, $1,600. One of them just has it all going to the mortgage. The other has it going to mortgage and then investing. And then once Melissa has her mortgage paid off in 30 years, she's going to begin investing the full $1,600. So if you're one of those people saying, well, I want to be Paul because I can invest more sooner, that's true. He can invest $1,600 earlier than Melissa can, but there's more to the story.
Well, yeah, because Melissa's going to have a huge head start on him. She's going to start saving $556 a month right from day one. She's 33 years of age. We know that that is a great multiplier when you're that age. So show them the rest of this, Bo, and then I want to talk about what if things don't go like Paul and Melissa anticipated when they hit the age of 43, which is 10 years after they bought this house.
So what we can see is that if you're out there listening to this, make sure you go out to YouTube so you can actually see the visual here. They both start with the same mortgage amount. They both start with a mortgage of $240,000. Well, Paul is going to pay all of his mortgage down by the time he gets to age 48, and then at age 48, he is going to start building up his investment assets. Melissa is going to start from day one building her investment assets and also satisfying her mortgage, but she's going to satisfy the mortgage at a slower pace than Paul is going to. So we said, just like what you mentioned, Brian, if we look out 10 years, how do they stand or where do they stand? Well, after a 10-year period, when they're both 43 years old, Paul still has an outstanding mortgage of just over $90,000. And he has no investment dollars built up. He's not begun saving yet.
He's paid off a lot of debt, though.
He has a lot of equity in his home. Melissa has double that mortgage amount. She has $184,000 of outstanding mortgage, but because she started adding to her army of dollar bills, she has built up almost $102,000 of investable assets.
So why did we choose 43 to show this? Because this is a point that I see in our comments section on YouTube, and I'm like, guys, you're missing the big point. And there's two stories I have to share on this. First, I think I've told you guys, from my Sunday school class, I had a widow come up to me and said, please, 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 make sure you share on your show that paying off all the debt is not always the greatest thing, because her husband passed away, she still had kids in the house. Everybody told her, go pay off your mortgage so you'll at least own the house and everything's okay. Well, the problem is she did that, and then she didn't have money to cover a lot of the education needs, a lot of the other stuff. She says was some of the worst advice she was given, but everybody was well-intentioned saying, get out of debt as soon as possible. Well, I see this, and I immediately thought about my childhood. But we even have an article to pull up. This, you can see, this is June of 1988. My world changed in life.
Okay.
And what happened was my dad started working for this McKesson back right out of college, and he did that for 20-plus years. And then at age 43, McKesson decided to get out of that division, and he was out of a job. And, I mean, life was completely different. We lost company cars. We were living off my mom's teacher's salary. Now, here's what's crazy. Now, I can't imagine being a parent. Us kids, we thought this was the greatest summer there was, because Dad was home.
Because he was home,
He was home for that period while he was finding another job. But it showed me, and this is one of the reasons why I always want to be self-employed. This is one of the reasons why I realize you have to be careful if you give 20 years to a company that doesn't really give you a path forward. You could get yourself in a pickle of a situation, but it goes even further. What if Paul and Melissa, 10 years into this mortgage, their dream house, they love where they are, but all of a sudden they realize, oh my goodness, I've still got to pay the mortgage on this house. Even Paul, who's 5 years from the house being paid off, only owes $90,000. He still owes $90,000. It's not like the mortgage company goes, man, you've done a great job, Paul, of building up equity, so we're going to be in this with you and protect you. They're going to be like, hot diggity dog, this guy's about to lose the house. Look at all the equity we're going to take down. That's what the bank is thinking. I hate to be mean like that, whereas at least Melissa will have liquid investment assets that she can use to pay mortgages, use to pay her grocery bill, use to pay utilities. Melissa's going to have options because she has liquidity behind her name. Even though we might think it's great to pay off this mortgage debt as soon as possible, there's a time and a place, and that's why I always ask you, are you 45 and over? If you're not, goodness gracious, get that army of dollar bills working for you. Take advantage of the compounding, because remember, 88 times over happens when you're 20. 23 times over happens when you're 30. By the time you're 40 years of age, that drops down to 7. So you can quickly see 20, 30. Those are the years where you're getting maximum compounding growth for your army of dollar bills. Don't take those years for granted.
Yeah, I think, and we see this riddled all through our comments. People say, you know what? No. It's going to be safer. It's going to be better if I pay off my house sooner, because then if I lose my job, if remember, Paul has actually saddled himself with a $1,600 a month payment. If he loses his job, just like you said, it doesn't matter how much equity he has built up. He has to make sure that next month he can come up with that $1,600. And if he doesn't get another job, the next month, and the next month, and the next month. So the question we asked is, if you were these two individuals and 10 years into your mortgage, you ran into a dire situation or an uncomfortable circumstance, would you rather be Paul, who has $210,000 of equity in his home but no liquidity, or would you rather be Melissa, who she doesn't have as much equity in her home yet, but she has $102,000 of liquid investments that she can help bridge the gap on?
Realize when we talk about housing, equity, real estate's awesome, but it's considered non-liquid. It takes, think about all the different steps that require to get your money out of your house. And a lot of you are like, well, you just go get a home equity line. No. Remember, I've fallen into that trap. I've shared with you guys when we went through the Great Recession, I had 6 figures of home equity in my house down in Georgia, had 0 cash because I was like, why would I need cash? I have a checkbook. I have all this equity. I have 6 figures of equity until the day you don't, because the bank very quickly can send you a letter saying, hey, that access to equity you thought you had, we're shutting it down.
Yep.
It no longer exists. And I think we even heard somewhere in the chat room somebody had mentioned that they were starting to freeze home equity,
That's exactly
equity
right.
lines and other things. So bad things tend to happen together. So there's a chance you'll lose your job, but also real estate market will be struggling, so you can't go sell it and turn that money into liquidity. So it's good to have options.
So we actually, because we're nerdy enough, we said, let's run the numbers. We can get full-time equivalent Daniel to run the numbers on this so that people who are just so sick of paying the minimum can know maybe there's a better strategy that still lets me respect what Brian and Bo are sharing on. Don't get crazy and carried away on prepaying the low interest mortgage debt, but still lets me check the box to know there's a better way of prepaying debt.
And here's what we wanted to do. We wanted to make it fairly simple for you guys. We didn't want you to have to break out an amortization schedule and do all kinds of calculations. So we wanted to look at 3 common strategies for paying off your mortgage, or how you should approach it. So strategy number 1 is just pay the normal monthly payment. Whatever the mortgage company says, based on your amortization schedule you need to pay, just pay the normal monthly payment. That's not going to prepay at all. It's going to pay it over the term of your mortgage, 15-year, 30-year, depending on your mortgage, and just do what they set out for you. Option number 2 is, okay, well, why don't I just pay a little bit extra? I'm going to round up to the nearest 100. So if my mortgage payment is $958 a month, I'm just going to pay $1,000 a month, and I'm going to let that be the way that I pay off the mortgage. Or the third one, and this one's kind of clever, I like this. Rather than paying your mortgage payment monthly, so having 12 payments per year, you say, I want to pay biweekly. Well, if you pay every other week, you'd actually make 26 payments in the course of a year. Well, 26 payments is 2 more half payments than 24, so you're actually paying 1 extra monthly payment per year.
Hey, I do want to give a catch on 3.
Okay.
Just because we're going to show the numbers and I want to nerd out with you, but I want to tell you to be careful. Some mortgage companies aren't going to let you send half this week and then another half
in 2 weeks.
In 2 weeks. So you need to pay attention to what your mortgage company requires and actually allows. Don't use a third-party company. I don't want you paying $300 setup fee plus an ongoing maintenance, because you might get yourself into something you can't get out of. But it is worth a phone call. Call your mortgage company and say, hey, do y'all have a bi-weekly payment plan that's just a value-add service? And a lot of them will do. Now, if they don't, no big deal. We're going to tell you how to do this in a do-it-yourself type methodology. But it is one of those things you need to make sure you do it the way your mortgage company, because they're the ones that are doing the accounting. They're the ones who run the amortization table, and we want to make sure we keep them happy.
Yeah, so the real easy math is if you're someone who your mortgage company doesn't make available bi-weekly, just take your monthly mortgage payment, divide it by 12, and add the principal payment onto each month, right? And so that way, essentially, over the course of the full year, you will have made 1 extra payment over that 12-month period.
So let's get in the math. Let's nerd out on this thing, Bo. Go ahead and show them where we're at.
So here's what we want to say. Let's assume that we're going to do a 30-year mortgage. So everything we're looking at is 30 years. Let's assume that right now mortgage interest rates are 4%, and we're going to buy a $250,000 house. We're going to put 20% down. So that means that we're actually borrowing or financing $200,000. Well, if you choose to go with strategy number 1, which is just normal monthly payments, your monthly payment is going to be $954.83 a month. Well, because you are borrowing some money, you got to pay interest. So over that 30-year period, you will pay $143,739 in interest. So the actual cost of your house, is a $250,000 house. What you actually paid for it was $343,739, and it took you 30 years to pay that. So that's kind of our baseline. That's where we're starting.
Yep.
So now let's look at strategy number 2. We're just going to round up. So instead of paying $954.83 per month, we're just going to pay $1,000 per month. Well, if we pay $1,000 per month, we're going to pay total interest of just under $123,000. That's going to take the total cost of our $250,000 house to just under $323,000. And that means we're going to have the house paid off in 25.2 years.
Wow.
So just by rounding up a little more than $40 per month, we knock 5 whole years off of the mortgage.
Pretty powerful stuff.
It's insane. So now let's look at strategy number 3, which is instead of paying monthly, we're going to pay biweekly. Well, what that means we're going to do is we're going to pay $1,038 of cash flow out per month. The total interest we're going to pay is going to be just over $120,000. The total amount that we're going to pay for the $250,000 house is actually just over $320,000. And this one actually pays off even a little bit quicker, pays off in 25 years even.
So we have a payoff slide, and this is if you're looking on YouTube, I want you to. This is what I like is that we actually put everything into different columns and rows, so you can actually do a comparison. Now, coincidentally, Daniel chose an amount with $200,000 that it worked out to be almost the same, whether you're rounding up $100, and that makes sense if you look at what the monthly payment is. This could actually become a bigger or smaller difference depending upon how big your mortgage actually is on looking up the rounding up or biweekly, but it's still a powerful concept. And this is where I'm going to give you guys permission because I think it is powerful that just rounding up, like you said, Bo, to $1,000 from $955, or to $1,040 or $38 a month. I mean, it's not that much money, but it can make a dramatic difference. So I'm going to give you guys permission. I still stand by the fact that if you are under 45, I want you focusing your army of dollar bills on saving for the future. But I'm going to give you a little bit of grace that if you want to round up or if you want to do a biweekly payment plan because paying the minimum is absolutely driving you crazy, I think it's okay. Now, don't misread this. We could have gone in a completely different direction and showed you how every bit of that $45 on the roundup or even the 70, close to $80 a month on the biweekly payments, and if we invested that and earned 9 or 10%, it would have still been better to invest that money. So do not mishear that saving that 5 years is now superior to investing. It's not. It's just that I do agree with the fact that I think you can chew gum and walk at the same time. So it is one of those things that if you are serious, and that's why we give you the goal of saving 20 to 25% towards the future. If you have checked that box in your financial order of operations, then it is no problem to also be rounding up or doing bi-weekly. I think those things can actually happen at the exact same time, and you're going to end up in a much better place.
Yeah, Brian, so it's interesting. Right now, we are and have been in this remarkable low interest rate environment. And while we talk all the time about how that's like really negative for savers, folks in retirement, folks living on cash, there is one really, really, really bright spot that we see that's a great financial planning opportunity that folks can and have been asking us if they should take advantage of. And that thing is possibly refinancing.
Well, here's how this show comes about. One of our principals here at Abound Wealth, Carter, is building a house.
Yep.
And he comes in and goes, guys, I just locked in because he's moving into his house first week of June. He goes, locked in, 30-year mortgage, 3%. I was like, get out of here. 3% on a 30-year mortgage? You'll never, ever, ever be able to move because you'll never, ever, ever get a price that low again on a house.
You know what really ticks me off about that? I just closed on my house back in January. I didn't get 3%.
You didn't stick the landing.
I didn't stick the landing.
So it is one of those things.
Early.
So when I hear that you can get 3% on a 30-year mortgage, I'm like, we got to do some content on that. But we also need to make sure the Money Guy family knows how to do this properly because it's like most things when you're dealing with the dangerous instrument of debt and leverage, so much of our consumer society is doing it completely wrong. How you can take something that's good, like the idea, here's how simple this is. If I could just refinance, and I'm going to let you give the definition of what a refinance is, but if I could just lower my interest rate that I pay on my mortgage, that's a good thing for me. How could this go wrong? It be bad? Yeah. I'm going to show you that most people do mortgage refinances completely wrong, and we're going to show you how to avoid those traps.
So at the very basis level, you may be sitting there saying, okay, I've heard people say that, but I don't even know what a refinance is. Yeah. All a refinance on a mortgage is it means you're taking your current mortgage and you are adjusting some of the terms from your original contract. You're essentially closing out one loan with a certain amount of terms and you are replacing it with another loan with different terms, whether that be length of time or interest rate. We'll kind of talk about that, but you're essentially adjusting the terms of the money that you've bought to pay for a house.
And why shouldn't you be able to do this? Because think about it, mortgage lenders have no problem changing the rules on you, and the fact that you could close with your local bank down the street, but you're going to find that they assign your mortgage, essentially sell your mortgage to somebody else. So you might as well take advantage of this too and see if, while interest rates are low, are there ways I can improve my financial situation?
So we started thinking, Brian, about all the different terms that you sign on whenever you sign a mortgage, whenever you go to borrow money, what are the things that you're committing to? And we started really thinking about, all right, what are the reasons that people do refinance? And we were able to really distill them down to 5. We think there are 5 main reasons that people refinance. And the number one reason, and you already alluded to this, is to decrease the interest rate.
And that's great. And that's a great opportunity. Lower that interest rate, lower how much interest you're paying, save that money in your back pocket, hopefully even accelerate how you're paying it down. And that leads to number 2 is how great would it be if we could decrease our monthly payment?
That's exactly right. A lot of folks say, you know what, I'm a little strapped or I have whatever going on. Maybe I want to refinance to give myself a little more breathing room in my month-to-month cash flow. A refinance will certainly solve that problem for you.
And even, I mean, a lot of times, now, yes, you can go through your existing mortgage company, but if you've lived in the house for a while, a refinance might let you do a twofer where you get lower interest rates and you get rid of PMI too. If you didn't put down a full 20%, this is a time to do that as part of 1 and 2 in combination with each other. And then number 3 is maybe this is an opportunity, and this is one you have to be very, very careful with. This is a measure twice, cut once, because I don't want you to make a bad financial decision. But maybe you're refinancing to get cash out of your home.
Yeah, Brian, and the third reason that people generally, we see, do a cash out refinance, now, sometimes this is good, sometimes bad, but they do it to consolidate debt. Maybe they have some outstanding credit card debt, or they have auto loans, or fill in the blank. They recognize that home might have a tax-advantaged, really low interest rate, so perhaps they want to refinance to consolidate some of that debt into it.
I would just caution anybody, because debt is one of those dangerous instruments. It's one of those very fearful things you should use in your financial toolbox, that if you are going to use this for consolidating debt, that this is something you really internalize hard, measure twice, cut once on, because I do worry too many people hit this button too often just because your house naturally appreciates. When you find out people are doing cash out refinances every few years, you never actually own your house. And that's something that people need to be very aware of. Number 4, increase or decrease mortgage period. Man, this is a big one. We've actually gotten a lot of views when we talk about this, and we will, by the way, be ringing that bell again when we talk about 15-year, 30-year mortgages. Lots of chances there. And a lot of times, look, we get it. When you're younger, you might need that longer amortization period so you have more flexibility, because you're trying to not only pay for the kiddos, you're paying for saving for retirement, but you're also trying to make sure you have a house, a shelter over your head. But you're going to get to a point where maybe you get a little older and you want to bring that down to a 15-year or 10-year or 20-year. You know, you have options. So that's another reason to refinance. And then, Bo, the last one is, let's talk about this one, move between a variable and fixed interest rate.
Yeah, it's not uncommon for someone when you buy a house, maybe some set of circumstances that caused you to have an adjustable rate mortgage. Well, now interest rates are super low. You may want to refinance and lock in that long-term, very low rate. So a lot of people refinance just to go from an adjustable to fixed, or sometimes from a fixed to an adjustable rate.
The question I always have, because traditionally, if you're somebody, because realize you're talking to a guy, my highest mortgage rate, and I did a little dance after I got it, was 6 3/4, and I was so excited about
like
6
so
3/4.
high right
I know,
now.
but that compared to I'm sure my parents could tell us stories that double-digit mortgage rates. But I've often wondered, because typically you tell people if you're only going to be in a house for 2 or 3 years, look at a variable rate because you're going to save some bucks.
Sure.
When rates are 3% on a 30-year mortgage, I almost wonder if, yes, maybe even the variable is a little bit lower, but why not do the fixed just in case life throws you some curveballs and you're there a little bit longer than you thought?
You know, historically, Brian, we've actually counseled folks, hey, maybe you should look at a 5-1 jumbo or a 7-1 jumbo or a 7-1 arm or 5-1 arm. We haven't been saying that a whole lot lately.
Yeah.
It's really been looking at fixed rate mortgages. So That is one of the reasons people refinance. It's just not right now. They're not looking at a bunch of adjustments.
So I will tell you, I think if you're a young person and you're maybe on your first home and you're trying to figure out, should I do variable, fixed? Guys, this is a chance of a lifetime here with low interest rates. Don't blow it, because I'm not so sure 10 years from now, 15 years from now, we're not going to look back at this golden age of low interest rates. So pay attention to those fixed income rates, those fixed rates.
So we've talked about some of the reasons why people do that, but it's not all sunshine and rainbows. There are some dangers that are associated with refinancing that we ought to talk about. There are some negatives or some downsides that we want to look at.
Only in America can we turn something positive like refinancing to get lower rates is it actually becomes a dangerous financial game for you. So let's jump into these. But first of all, it can actually be expensive.
Yeah, I was surprised by this. And I don't know if it was you or full-time equivalent Daniel that found this, but the average closing cost nationally is almost $5,000. So to close on a new refinance could cost as much as $5,000. That's expensive. That's not a small amount of money.
And it ranges from 2 to 5%. You're like, well, that's a huge range. Why would it be such a broad range between 2% or 5% on closing costs? The reason is, realize every time you refinance, your local government has recording fees, has state stamps. They have all these, they got their hand in your cookie jar. You have title insurance. You have all these things. So depending upon how your state looks at mortgages, taxes mortgages, you can see a big variance in what the closing cost is in your state.
The other big risk, Brian, and you said this kind of earlier on, and we'll kind of revisit, is that you never actually own the property if all you ever do is refinance. If you keep recasting, it makes it real hard to actually ever build equity in that home and actually own the piece of earth that your house sits on.
You create a carousel of resetting amortization tables. So your 30-year mortgage could very easily turn into a 45-year mortgage. And I think those are the risks you run. And then we put this part in there because this is where it can get dangerous with refinancing also, is you can actually cost you more money over the long term, even with a lower interest rate. And what do we mean by that is, look, you're extending the term. I talked about that with the carousel of amortization rates resetting, the tables resetting. But you also, every time you refinance, a lot of times your mortgage lender will say, okay, you either can take a premium on the interest rate or you can just roll the cost in. And a lot of people will say, well, just roll the cost in. It'll be okay. So you're actually increasing the amount you're financing. And then we've already talked about this as well. A lot of people take cash out when they refinance as well. So all those things in combination are actually dangers because you might not actually be working towards owning your house.
So we thought in true money guy fashion, perhaps it would make sense to look at a case study, right? Just kind of walk through an example of how most people go about refinancing. So we said, all right, let's assume that you have a house that you bought 10 years ago. So you have now been in the house for 10 of your 30 years. Let's assume that you still owe $100,000 on the outstanding mortgage. Your current interest rate on your mortgage is 5%, and you recognize that rates are low, and so you want to refinance to 1%. So you're going to save 1% on the mortgage rate. And let's just assume that the cost to refinance this house is about 2% of the loan amount, or $2,000.
Sure.
So, okay, let's talk about the original loan first. If you look at an amortization schedule, and basically that just shows a list of all of the payments. So if it's a 30-year mortgage, there are going to be 360 total payments. You have your payment, and every payment is composed of two pieces. There's an interest component and there's a principal component.
Right.
And the way that amortizing loans work is you pay more interest early on, and then it slowly decreases through time. You pay very little principal early on, and then it increases through time. That's the way that the payment changes. So if you find yourself in this situation after 10 years, you're looking at month 121. You've been in there in 10 months. If you were to just stay in your current mortgage, you would continue to pay $660 a month.
Right.
That's your total monthly payment. So what most folks say is, okay, I want to do this new mortgage. I'm going to go refinance. I'm going to go from 5% down to 4%, and I'm going to do a new 30-year mortgage. Well, the great news is your payment actually decreases. You go from $660 a month down to $477.
More money in your pocket.
And not only that, because the interest rate went from 5% down to 4%, you're paying less in interest. You went from $416 in interest starting in the first month to only $333 in interest.
Before you hit the button, I already see something that gives me a little bit of a red flag. look at the principal on the chart. Is old amortization, it's $243 of your 660 is going towards principal. Look at the new amortization table. I see principal, yes, interest is lower, but principal is only $144. That's almost $100 a month didn't go to principal.
That's right.
What happened?
Well, it's that part that you took off, that part that you're saving some interest, but you're also resetting the principal. So what actually happens with this loan is as you move through time, rather than having your house paid off in 360 months or 3 years, it actually took you 480 months or 40 years to pay off this home loan.
Wow, this is what I love about math, is because we have shown how you can take something very positive in the fact that you saved if you take an interest rate from 5% to 4%. Guys, that's a huge dramatic drop. You have essentially cut that rate by a fifth, which is a great cost savings measure. But somehow, and I know you're going to show this, we're going to figure out how we can pay more interest as well as take longer to pay off. Put that into numbers.
So here's the rest of the story. If you compare what you would have done originally versus where you were after you refinanced, you actually paid an additional $13,480 in interest, and it actually took you 10 extra years to own your home. So I would argue in this case, refinancing was not an advantageous strategy.
Yeah, it was done the wrong way. By the way, we have all the components here for this to be an actual happy ending and a good story. And we're going to try to show you how you turn that frown upside down so you do refinancing the right way. Before we get, because what you're going to do, you'll get a lot of people excited when you start talking about refinance. You're going to get all the mortgage lenders. You're going to get your local your government, because remember, there's recording fees. There's all kind of stuff that's going on, title insurance. When you refinance, it is a big legal transaction. Is there a way that we can still end up with the net benefit we want, which is lower interest rates, without having to go through all the rigmarole? Yes. And it's called this simple step. We call this the lazy way, a rate modification.
Now, you may be wondering, hey, what does a rate modification mean? Oh, well, that's just simply a process where they modify your rate. It's exactly what it sounds like. You call your current mortgage lender, the person who currently holds your mortgage, say, hey, I know that interest rates are dropping. I could go refinance and you could lose this loan and I'm happy to pay someone else for the next 30 years, but would you consider just modifying my rate and dropping it to be more in line with market?
Now look, I'll be honest, when you call with this, you do need to tell them, I'm considering moving and refinancing. They're probably going to be like, all right, but you need to ask again, be like, look, I specifically want to know, and the process is called this, do y'all offer a rate modification process? And look, they don't do this for charity. If they do allow this, and I know a lot of the credit unions we've done mortgages with, they've been the easiest ones to deal with. You'll call them up, reach out, and they will have a fee. They will call it a modification fee. It'll be a few $100, and they will just that easily. There's not a new closing. It's basically just you are agreeing with your lender to change the terms so that you don't walk and vote with your feet and go refinance.
And the thing is that's beautiful about these, we just said the average cost of a closing is like $5,000. These things, at least in our experience, a couple $100.
Yeah.
So it's much less cost prohibitive than working through an official refinance. But let's say that you call and they say, okay, no way, we're not going to do a rate modification. The next thing you move to is, okay, I want to refinance. How do I figure out if it makes sense?
Well, you first need to do, it's just like, I think most of us, we tell you, you don't need a financial advisor until you get to $400,000 to $500,000 in assets. So a lot of your financial plans are done, essentially, I call them napkin financial plans, or we've done 30-minute financial plans where you can go to the website, download the content on that. Well, a lot of times you're probably looking for just an easy calculation. Is there a back of the napkin calculation where I can figure out if refinancing makes sense? And we think there is an easy way. But walk them through the 2 steps that are needed to do this. And then you can figure out if you want to go even deeper into the process.
That's right. So the easy way is pretty simple mathematics. You take your old rate minus the new rate that you could receive, multiply times your outstanding loan amount. That's going to give you about your annual interest savings this year. So in the example we had, 5% minus 4% times a $100,000 loan, it's $1,000.
Yeah.
Now look, this is simple math. Remember, amortization schedules work differently. We'll talk about that in a second. Well, if you know that it costs you about $2,000 to refinance, and you know that you save about $1,000 in interest in year one, you could come to the conclusion that you will break even at about 2 years. So long as you're going to be in the house longer than 2 years, it probably makes sense to refinance.
So I would think about this in terms of, if you know you're going to be in the house for the next 6 or 7 years and your math is that simple, 2 years, you can probably just know this is what I'm going to do. Now, we're going to show you in the next, the money guy way, things you need to take into consideration, but it probably is going to make sense. Now, if you're somebody who knows you're going to be moving in 18 months, 3 years, and you do this, you still going to probably need to go a little deeper into the process because it's not going to be as black and white on the decision making. So let's kind of transition now to what we call the money guy way.
So again, let's lay out a few assumptions. You bought your house 10 years ago, so you're on a 30-year mortgage. You've been in there for 10 years. You still owe $100,000 on your loan. Your current interest rate is 5%, and you have an option to refinance to 4%, and your closing costs are going to be about $2,000. We've already laid out for you the standard amortization schedule. Remember, it was going to be a monthly payment of $660 roughly a month. You're going to pay that every month for 360 months until your loan is paid off. Well, we showed you could refinance to a 30-year mortgage and pay on that thing for 40 years, or rather than allowing your monthly payment to decrease, you say, you know what, I could afford $660. I'm just going to keep paying $660 a month. So I'm going to make the minimum required payment of $477, but every single month I'm going to pay an additional principal payment of $182 to keep my monthly payment the same.
Bo, this looks exactly like the wrong way illustration with one big behavioral modification. Is that we have done the same refinance, same closing costs, same structure, but it's that additional column over there called additional principal, and you nailed it. You pay the exact same that you're paying on the old mortgage, $660 a month. You don't take the new required payment. You actually goose it and pay a little bit more. And it's just amazing when you add the principal plus the additional principal. Now, I mean, you are vanquishing dragons if you compare that to the original principal payment. And there's a lot of savings that are going to come. And it's going to really, talking about make your heart dance, is when you see how much faster you're paying down the mortgage.
So here's what I think is beautiful. If you continue on this path, you actually have the house paid off in 332 months. You would have saved, over the course of owning your home, $17,828. That is real money. That's actual savings of going from 5% down to 4%. And you will have actually paid your mortgage off in 2.3 years faster without changing your monthly outflow. Still paying the exact same mortgage payment, you just were able to put an extra almost $18,000 in your pocket.
And all you have to remember is you take your old payment, but you have a new rate. You just keep paying like it's your old mortgage. So you effectively lock in the benefit of that lower interest rate. Now, a lot of you are going to try to recreate this. You're going to say, amortization tables, I think I have Excel or I have Sheets. I have Google Sheets I could use. There's an easier way, guys. If you'll just type in on Google or whatever, bank rate, mortgage, amortization calculator. Bank rate actually has a pretty good one. If you are somebody who's comfortable with spreadsheets, I know both Sheets as well as Microsoft Excel have great templates that are right there. You just go under New, Templates, Amortization Charts is one of the first things you can go to. You want to use those tools if you want to go do a deeper dive into the process. Let's kind of pivot, and I want to talk about the cost of refinancing, Bo, and how we kind of handle that. Because a lot of people, you've decided, yes, there's a cost savings here. I should definitely do a refinance to lower the mortgage, to give me more flexibility. But then you're like, okay, now I have a decision. Because the lender is telling me I can do a no closing cost. That sounds great.
Because, they say that on average it costs like $5,000. I don't have $5,000 sitting around, but man, I really want to refinance. So
what's the catch? When somebody tells you you can do a no-cost closing, you're like, there has to be a catch to that. And what they're typically doing is, realize lenders, when they price mortgage rates to you, they can actually give you a higher interest rate and they essentially get a subsidy from the mortgage companies where a portion of that money gets kicked back out to cover the closing costs. So you can take a premium on the interest rate or you can just pay the closing costs.
Yep. So just like in all the other examples we've laid out, there's some mathematics you can do pretty easily to figure out, okay, should I pay the closing costs or should I take the premium? So let's assume that you could do exactly what we said earlier. You could pay the closing costs and you could get a 4% rate. Or if you wanted to not have the closing costs, you just have to take a 0.25% premium. You want to have a 4.25% rate. Well, what we find is that the mortgage payment's going to be the same in this example. It's going to be $659 per month. But as you go through time, payment stays the same, goes all the way down. Mortgage is still paid off in the same amount of time, but what happens is you want to calculate your interest savings on a running schedule. So like in this example, in month 1, the 4% rate would have saved you $21 over the 4.25% rate.
Right.
You want to add up your monthly savings every single month, and in the month that your monthly savings crosses over the amount you would have paid to close, that's how long it takes for you to break even. That tells you if you're going to be in the house for less time, whether you should refinance, or if you're going to be in the house for more time, whether you should pay the closing costs.
So just to kind of clarify what this is showing on this illustration is, remember, you're 10 years already into your mortgage, so that's why you're in month 121.
Yep.
So when we see it takes 217 to reach break even, that's really 96 months
That's right.
from the refinance event. So if you think about it in those terms, in this illustration, 0.25%, it's going to take 8 years to recoup the $2,000 of closing costs. So you have to ask yourself. Now, in reality, I will tell you, because 0.25% is pretty tight. We've seen things where this is why it is important that you understand this concept, is that there's pricing. You can get into some weird arbitrage situations where maybe your savings on a refinance is so big that you can actually recoup closing costs easily within 3 years. I've seen
that happen.
I've seen them even faster than that. The only reason this is taking 8 years is because it's a 0.25% difference. That's just not a big spread on interest rates. But it is one of those things you need to understand. This will help you understand whether you should pay closing costs or do a no cost and take a premium on the interest rate. It's simple math. Where is the break-even point? And we're trying to give you the tools so you can understand that.
The reason we want you guys to know this and understand this is there used to be a common rule of thumb that, okay, if I can save 100 basis points, if I can save 1% on my rate, then it probably makes sense for me to refinance. And that's a decent rule of thumb, but that's all it is a rule of thumb. We think if you're going to analyze for your personal situation, you have to actually break out the numbers and look at it because so many variables can affect whether or not it makes sense for you.
Well, and we're talking about this show specifically is on refinances, but I think that it'd be crazy in money guy fashion if I didn't go a step further and tell you a lot of you might be buying that first new house. And you're going to get asked when you buy that first new house, do you want to buy down the rate? Do you want to pay points? That's all. And by the way, it's the exact same calculation. Yep. You're going to want to go see what they're charging you for the lower interest rate, because you can actually buy down the interest rate. Go see what they're going to charge you to buy down the interest rate on this house and see when the break-even point. Now, here's something from a taxability standpoint you guys need to understand. When you're buying a brand new house, those points you pay are deductible in the year of purchase. When you refinance a house, if you're paying any type of points or any type of closing costs on the refinance, if you roll it in or you even pay it out of pocket, you can recoup that from a tax standpoint, but it's going to be amortized over the length of the loan. So if you do a 15-year mortgage, it's going to be divided by 15. If you do a 30-year mortgage, it's going to be divided by 30. Now, the good news is if you refinance 6 years into this new mortgage, the government lets you recoup all those closing costs when you do the refinance. But I feel like it's important to understand new purchases, meaning a new home to you, is fully deductible in the year of purchase. A refinance is going to be amortized.
Why does this matter to you guys? Obviously, what we're trying to teach with the Money Guy Show is how to stretch your dollars 5, 10, 15% further than your peers. You could be someone who goes out there and you just buy a house and you pay on it for 30 years and you get it paid off and that's fine. But we want you to be those financial mutants that when there are opportunities, like right now when interest rates are super, super low, you know and understand how you can take advantage of those opportunities to take your personal finances to the next level.